the internet was built without a couple of critical pieces. One was identity and one was money, natively built into it. And that caused the internet and the web to do some disturbing things.
And so if you think about owning the ether, getting capital appreciation, on top of that, getting a yield, that is actually a smarter and better treasury asset.
This is the Assetizer Podcast.
Hi, everybody, and welcome. My name is Tom Lyons, and this is the Assetizer Podcast. And today we have a very, very special edition on a whole number of counts, one of which is for the first time ever, I'm welcoming a co-host to the program. Mark Arasaratnam is the head of GenTwo Digital. Hi, Mark. Welcome.
Hi. Thank you for having me.
Yeah, it's always a pleasure. And, who knows, if you're really good at this, you can take it all over.
Let's see.
Okay. And then, of course, we have two very, very special guests with us today. Joe Lubin is co-founder of Ethereum and the founder of Consensus and one of the most important figures in blockchain and crypto. And Joseph Chalom is since recently the CEO of SharpLink and has quite the background in digital assets and in financial services coming from BlackRock. And gentlemen, thanks for taking the time. Welcome to the show.
Thanks for having us.
All right. Joe, we kind of want to start it with you. As I mentioned before, our audience is not necessarily crypto native, although a lot of them are or are very interested in this space. And before we get into some of the more technical questions, just wanted to maybe you can give us a bit of an update on Ethereum. It just turned 10 years old. Where we are, I know it's been a bit of a ride the last couple of years. So maybe a bit of background on that and a little bit maybe about yourself.
Thanks, Tom. Should probably mention one of my greatest achievements is collaborating with you on a bunch of different narratives over the years. Always enjoyed it.
That's very nice. Thanks a lot. Yeah, I missed the mesh, I have to say.
Yeah, well, you're always part of the mesh. That'd be consensus mesh for the audience. So Ethereum's firing on all cylinders and keeps adding more really interesting cylinders. Ethereum for 10 years. People are constantly mentioning that Ethereum has been up for all of those 10 years, has been nonstop operational, which is a remarkable achievement. But for 10 years, 11 years, the Ethereum ecosystem has been building enabling infrastructure because we believe that the world will transition progressively to decentralized infrastructure, and we're seeing that really pick up steam now as traditional finance has gotten permission really from regulators and legislators to embrace the technology. So we, over the last 10 years, have become more affordable, very affordable in terms of transaction fees and block space, and very scalable in terms of our ability to add horizontal and vertical scalability, and very usable and very legal in the United States of America, with the government essentially being wind in our sails rather than headwinds. And so we're seeing traditional finance onboard itself in interesting ways to DeFi, and the ecosystem, the sentiment in the ecosystem is very, very high. And so happy to drill down more on any of those aspects, but it is our mainstream moment, and I look forward to seeing many applications be built that essentially help us cross the chasm into mainstream culture.
No, that's great. I think we'll have do some more deep dives later in the show because we want to get back to that. But thanks. Maybe Joseph, over to you.
Sure. When I think of Ethereum, I think of it as a new kind of public infrastructure, one that will be entirely decentralized. You can think of it as, I know Joe has described it as a world computer. So something that essentially provides a settlement layer for all sorts of financial transactions, economic activity, AI agents, and it's meant to be kind of that collective connective tissue of the world economy. That sounds very futuristic. I have a background in traditional finance. I've spent 20 years at BlackRock helping scale fintech SaaS businesses, as well as spending the last 5 to 6 years before joining SharpLink leading digital assets. And what is the motivation? It's not just about investing or selling products to investors. It's really trying to provide a bridge between traditional investors, customers, advisors, and crypto finance. And by that, I don't just mean the $4 trillion of digital asset market cap. We're really thinking about the 100 trillion that will be tokenized. And I'd love to spend time thinking through that.
Yeah. So I love the term world computer. We started using it a long time ago.
I remember.
Exactly. Vitalik has recently backed off on that a tiny bit, and I think temporarily, and he started calling it the world ledger. And that indicates that it will be primarily utilized by finance in the near term, and will be heavily utilized by layer 2 systems. Part of our scaling strategy has been to treat layer 1 as the base trust layer and decentralize that maximally, and then have lots of execution environments called layer 2s that inherit roughly the same security guarantees of layer 1, but they provide different kinds of scalability and different kinds of functionality. So I think Satoshi Nakamoto invented decentralized trust, and we have this new trust foundation for the world in Bitcoin and Ethereum. And then we're building decentralized trust, a global, composable, interconnected finance system. And then on top of those two foundational layers, we can start building the world computer. I love the world computer because it reminded me of the ubiquitous computer in Star Trek, where you just go into a room and say, computer, and she says working, and you just go about your business and fire your credits around and get whatever you need done.
Okay, maybe just real quick, since you brought that up, Joe, just to get your sense of when we're going to get now into the more non-financial use case. Because as you remember, when we were doing the Blockchain Observatory and Forum for the EU, and also when I was at the Enterprise Ethereum Alliance, I was doing a lot of stuff on non-financial use cases, right? And I know that was always part of the mix here. So you think just a matter of more time?
Yeah, exactly. So more infrastructure, more time. For some reason, the world really cares a lot about money. It seems to be foundational to our economy, and it's kind of good, I think, that we're paying so much attention to the money layer in decentralized finance, because the internet was built without a couple of critical pieces. One was identity and one was money, natively built into it, and that caused the internet and the web to do some disturbing things. So essentially, it ended up building out the playbook of the 20th century, where the internet just became a gigantic mall, selling lots of stuff, and big tech made use of AI to learn more about ourselves than we know. And essentially it became an advertising and e-commerce machine, the biggest, most intelligent machine ever created. And it did end up turning into a weapon of mass manipulation. And so by having the economics front and center, where you can inspect everything, where you're actually paying for everything. There will certainly be advertising supported stuff, but it's much better to know explicitly what you're paying for and with what, rather than having your attention exploited, etc. So the next stages, I believe, will involve decentralized identity, reputation systems, and networks of social graphs, and I think that's just getting started. So I think networks of social graphs that we own and control, where our decentralized identity is at the root of that graph, and where you can attach all these graphs, and you can charge for your own social graphs rather than creating content for other companies' social graphs, and where you can reward people for contributing content or functionality to your social graph. I think that's going to be the next major revolution in the decentralized protocol space.
Well, if I want to just unpack that a little bit more, is this what's going to have to be built over the next couple of years to really get traction on this side, or is there other things that you're looking at in terms of what Ethereum should be building?
I think this is what needs to get built in order to move from world ledger to ubiquitous world computer, like multifunctional world computer.
Okay. And just on that side, because there's a lot of enterprise chains that are coming up now, right? So how does Ethereum win against those enterprise chains? Because they're coming up left, right, and center now.
Sure, I can take that, maybe focusing on finance and money.
Yep.
I think Ethereum has what I call the license to win. What do I mean by that? Having come from traditional finance, I know for certain there are 2 or 3 things that traditional financial ecosystem players care about. One is security. The second, for sure, is liquidity. And the third is what I would just consider experience. So if you take a step back, Ethereum has just celebrated, as Joe mentioned, 10 years from its Genesis block. Mainnet has never gone down. And when you think about that, what that means is that there has been a tremendous amount of just availability. And it sounds silly, but institutions care more about availability than they do about slick marketing when you really start making decisions. And second is liquidity. When you take a step back and think about the 3 types of liquidity that exists on Ethereum and the L2s today, the first being stablecoins, and you see a massive adoption curve happening today, around 280 billion of stablecoins, which Secretary Bessent suggest could get to 2 to 3 trillion over the next couple of years alone. 60+% of that is happening on Ethereum. The second is the idea of tokenized real world assets. Today, it's around 30 billion. Most of that, or the largest, is just tokenized treasuries. When I was at BlackRock, we launched BITL, which today is the largest tokenized fund in the world. That actually has immense opportunity for massive acceleration. Just imagine some of the biggest funds in the world, not measured in the single billions or 9-digit numbers, but there are funds that are measured in the tens, if not hundreds of billions. When those things start tokenizing, you're going to get to a tipping point, and over 80% of that is happening on Ethereum and its L2s. And then finally, DeFi, which institutions had shied away from because of a lack of regulatory clarity. Institutions are really starting to consider DeFi activity as something within the realm of possibility. If you look at the high quality liquid assets in DeFi, and by that I don't mean NFTs or meme coins, I'm thinking of locked activity in lending, borrowing, and exchange. A very large percentage of that is happening on Ethereum. So taking a step back, if you have long-term certainty and security, which Ethereum does, and 2, you have the most liquidity, you get to a point where Ethereum and its L2s have about 10x that locked transaction volume and liquidity of the next largest chain. And I can tell you, that's why institutions are going to gravitate towards Ethereum, despite the fact that you have other corporate chains that are launching for their own economic benefit. That reminds me a little bit of going back to closed systems, which we're actually trying to overcome. So the license to win is its longevity, its security, its developer community, and its liquidity. Joe, I don't know if you have anything to add. I'm trying to be very, very pragmatic here.
Yep. Companies use different kinds of databases, SQL databases, NoSQL, Graph, Vector, etc. And that's going to continue. And we'll see a lot of those databases getting more decentralized in the corporate context or in a consortium context, and speaking token, being able to plug in to different networks. Satoshi invented one of the most profound things ever, decentralized trust. If you have enough rigorous decentralized trust, you have credible neutrality, you have censorship resistance, and that's where Ethereum shines. So there's no other resource in the world like it, and Ethereum, Ether is the highest octane trust commodity, and Ethereum is trustware. It's a new kind of software. So every organization will have lots of different kinds of blockchains that they plug into or use internally, and invite their users and partners to it. A lot of that stuff will be done as layer 2s on Ethereum. Some of it may be done directly as layer 1 on Ethereum. All of it will talk to and run through Ethereum.
Can I ask a question on privacy, though? So if we're bringing real-world assets on chain, there's MiFID requirements for securities because privacy is a big deal. Is this something that Ethereum needs to be looking at or has been looking at in the last couple of years?
I would say if you look at version 1 of these tokenized real-world assets,
Right.
they are happening in more of a permission space on Ethereum and other L2s because of the historic lack of regulatory clarity. So you get the decentralized benefit, you get the neutrality, you get the programmability, you get the composability that Ethereum and the blockchain offers. But right now it's still going through KYC, KYB, because that's where institutions have to start. There needs to start with a credible bridge that they're comfortable with. Over time, I think the promise is, as Joe mentioned, when digital identity and digital personas and digital ratings and trust start existing, then I think the regulatory framework will adjust and institutions will be willing to work in a fully permissionless way, as long as they can understand that they're not necessarily interacting with really bad actors. So I think it's the beginning, and I think it's the right beginning.
Yeah, there are protocols usually using zero knowledge trust proving mechanisms that either run on Ethereum or sit in layer 2s on Ethereum. They need to get more performant, and so they'll get better and better.
Okay, so the lack of performance, they're not performant enough to get this stuff done. Is that what it is?
I think TradFi is moving on to DeFi in stages, and there are a lot of really valuable things you can do that are sort of low-hanging fruit that don't require rigorous privacy like that, and we'll just build it up over time.
Okay, so Joseph Shalom, I wanted to ask you a bit about SharpLink, the company you're the CEO of now. And SharpLink was a gaming company, and now it's changed to be something quite a bit different, or at least that's the perception in the public. So I want to maybe give us a bit of background on the company and what's been going on.
Sure. So SharpLink is a NASDAQ-listed company under the ticker SBET. Historically, it had focused on affiliate gaming businesses and revenue. This past June, there was a pivot to essentially focus on a digital asset treasury company. And by company, I don't say strategy, I mean a company, and I'll explain why. And I joined in July as the CEO because I genuinely believe that there is an Ethereum opportunity out there that is going to change the world. And I'll explain what I mean by that. And if you believe that Ethereum is a long-term, multi-decade transformational technology, then it is a great time to buy Ether, the token that secures that technology. And that's why we were formed, essentially as a treasury company that accumulates Ether, after raising money from investors. So we believe it's a long-term opportunity. I think in the short to midterm, if you accumulate billions and billions of dollars of Ether, there are tremendous opportunities to both support the Ethereum ecosystem through providing that ether, as Joe described, the highest octane trust wearer money, to bootstrap protocols to create value for our shareholders, but more importantly, over time, to build new businesses. And these are businesses that will not only be Ethereum aligned, but hopefully spin off Ethereum or Ether denominated revenue. And then you start getting a flywheel.
Right.
You know, share the long-term opportunity with investors, raise capital, buy Ether, stake that Ether in DeFi and other protocols, and then build businesses that are ETH denominated. This is more than a short-term strategy. We believe it's a long-term Ethereum opportunity and company. And that's frankly why I joined. When I was at BlackRock, we launched July of 2024, the first Ethereum ETF. And we spend tons of time really understanding the ecosystem and speaking to hundreds of investors about that opportunity. And I came to believe this is going to be the bridge between traditional finance and capital and this decade-long opportunity, which I think will be really, really rewarding for investors. So that's why I joined SharpLink. Joe, probably worth mentioning how we're related to your consensus company and why this strategic partnership makes us really differentiated.
Sure. So Consensus led a round of investment into SharpLink, $425 million round. We've since raised quite a bit more capital, and all of it's gone into buying Ether. We did that because, A, we thought it would be a really good business to invest in. B, we thought it would light a fire under the Ethereum ecosystem. It was the first big splashy Ethereum digital asset treasury company. And we did it because there was just great utility in having a mechanism that that could support Ethereum in different kinds of phases of its development. And what I mean by that is the Ethereum core developers and ecosystem weren't afraid to cede some pricing power at layer one in order to enable layer two, the scaling mechanisms to establish themselves and flourish. These are independent networks with different businesses behind them. And it caused the revenue that layer one achieved to shrink. It caused some of that value to be captured by the layer twos. It enabled them to flourish. And it created just a tremendous glut of block space, a lot of not jammed, not really packed block space. And that's great if you're trying to move the entire web and internet over to your technology. It has the side effect of making everything really cheap in the space, and that had the effect in the broader community, a little bit less so in the Ethereum community, of believing that Ethereum was squandering the value that it should be capturing. So it turns out that if you have one or more of these Ether treasury companies that are constantly buying Ether, it tightens up the supply-demand dynamics for the token. And at times when things are really humming in the ecosystem, price is likely to go up on its own. When it's not humming, those are great buying opportunities for us. And our goal is to amass as much Ether as we can, as quickly as we can. We do understand, as our friend Tom Lee has indicated, that there might be a number at which it starts to get a little concerning for the ecosystem. He's called it 5%. If one of these companies get to 5%, they're going to stop, according to Tom. I don't know what the number would be, and I don't know how many of these companies could get to significant single digits of percentage ownership of the monetary base. But I do know that Ether is the highest powered money on the planet, and because it's uncensorable, and and we will accumulate it, and we will use it to do many things that are aligned with the health and value creation in the Ethereum ecosystem, and that'll be enormously beneficial to our shareholders. And a lot of that infrastructure creation will operate in collaboration with consensus.
So maybe let me ask you then, or both of you, on that note. I think a fair amount of our viewers will probably know or have heard of Michael Saylor, they'll have heard of MicroStrategy, and have come across the concept of Bitcoin as a digital treasury asset. Or what makes Ether different than Bitcoin for this purpose, and potentially, better?
Sure, I'll give a couple of answers, but first you kind of need to tip your hat at Michael Saylor. So he's been accumulating ETH very rapidly for 4 to 5 years. And he's also been able to demonstrate a thesis, which is if you accumulate assets in a treasury, your company often gets a multiple of the NAV of your underlying treasury assets. He's been able to maintain a 1.5 to 2 times NAV. And part of that is because in public companies, revenues accumulate a future multiple. Also, this idea that companies that are public are often valued at future growth expectations. So like that has been a proven thesis over now 4 to 5 years. If Ether as a native treasury token has some significant advantages over Bitcoin. First is, yes, you raise capital, you buy Ether primarily for long-term capital appreciation, similar to what you would do for Bitcoin, but Ethereum works for you. And what do I mean by that? For your listeners, Bitcoin is a great store of value. The Bitcoin network does one thing exceptionally well, which is store and move Bitcoin. Ethereum as a network, if you own the native token Ether, you can stake it. And you could do a lot of things in the ecosystem that drive yield. A baseline 3% yield, but in DeFi, as you go up a little bit on the risk curve, you can accumulate even more yield. And most of that would be treated as revenue in a public company. So again, unlike Bitcoin, Ether generates native staking yield. That gets a multiple. And so if you think about owning the Ether, getting capital appreciation, on top of that, getting a yield, that is actually a smarter and better treasury asset. I would also say, because Ethereum has the opportunity and a community of developers and builders and applications, as a treasury company, you can do incredible things to bootstrap and build businesses to support that community, as Joe's mentioned. So I just think it's a great treasury asset. I think it's superior than Bitcoin as a treasury asset, even though I'm not one of these people who's religious about Bitcoin versus ETH or ETH versus Bitcoin. I don't wake up any mornings thinking I want to flip some other asset or token or company. I want to do the best for our shareholders and like really help build through this decade-long opportunity.
If I may just jump in here, you mentioned this idea of a crypto treasury company versus a general purpose company. So given that you just started and you're building out SharpLink now, what do you think is SharpLink's core identity now? Or does it morph over time? Does it converge at a single point in time? What's the core identity?
I think it has 2 or 3 identities, and I think it will morph over time. And I think even our brand will change over time to reflect that. The first is, just to start, it's a differentiated institutional Ethereum digital treasury. And when I say institutional, it's because we're building teams that have institutional experience to do this exceptionally well.
Yeah.
The second is, I think we clearly have a distinct advantage being associated with consensus, the deepest minds, the deepest subject matter expertise, the most commercial Ethereum company. And so when you go from just buying and accumulating and staking ETH to doing other things to bootstrap and participate in the ecosystem, we have that necessary advantage. And we're in the early days of figuring out what could be our next operating companies that are not just Ethereum aligned, but hopefully derive that type of revenue. And I think we're in that stage 1. we're in the early innings. We're less than 3 months into this journey. This journey is not to create a hedge fund or a dividend vehicle. It's to be a really benevolent actor to help bootstrap the community, and our identity will change over time as we build businesses.
Yeah, so there are three tracks of activity that we will pursue. One is raising capital and buying Ether. The other is achieving hopefully remarkable risk-adjusted yield on that Ether. And the third is using the giant pile of Ether to do important and valuable things in the Ethereum ecosystem. So you can imagine if TCP/IP was tokenized a long time ago, Microsoft and Apple and Amazon, and Google, they would all have to own some of that TCP/IP token. And so they would be building platforms, infrastructure, applications, and it's not a perfect analogy, but you can think of SharpLink a little bit like that.
Okay. I mean, this whole world is now coming to terms of what a DAT or DAT is. What do you think makes a good DAT? What makes an exceptional DAT versus the rest? Because there's a whole bunch of companies that are trying to do the same thing, but there'll be a few that survive. And for whatever reason, they're mostly US-centric versus what's happening in different other parts of the world. But in your eyes, what makes a very good DAT?
I think one is it starts with the reserve asset. You obviously have Bitcoin, Ether, which have really large market caps and communities. And to Joe's point, not only can you own the assets, stake it, but you can actually do remarkable things in that ecosystem. I think you're now seeing the long tail of DATs being formed, like token 142 will likely have a DAT, but I think that's more oriented to doing only one thing, raise the value of their, protocol token. So one is, I think you need to have a really good reserve asset. Two is, I think it's the leadership team. And I don't speak for myself. I speak about having the native capabilities, A, to run a public company, two, to actually do the right thing by investors, and three, buying and staking the ETH in a really good way. And third is, if you have this aspiration to do remarkable things in the industry, you can't do it with a couple of people. You need to do it through partnerships with, and in our case, we're doing that through consensus. And then the last thing is just super, super tactical. Your public stock better have some good trading liquidity, because the primary way people raise capital after that initial bootstrap foray, which is usually some sort of pipe, is through some at the market daily fundraising capability. And you do that only if you have deep liquidity. And we've had, periods where we're averaging $1 billion plus of daily trading volume between Tom Lee's BitMiner and SharpLink. I think it's over 95% of the daily trading volume. And it sounds like a hyper pragmatic answer to your question. But if you want to continually grow capital, you need to have that liquidity. And I think these four things trade together. They're not isolated.
Okay.
Yeah.
So, sorry, go on, Joe.
There are a good number of assets and approaches that can lead to a good DAT, depending on your investment time frame. If you want, from the investor's perspective, to be a great DAT long term, then you're going to have to grow the concentration of Ether, in our case, per fully diluted share. You're going to want to see real credibility in the upside of that underlying asset, and Ethereum has enormous potential to grow by many times. I'm a little bit bullish on Ether.
Just a tiny bit.
and then you've got to assume that Ether is going to get to a price at which it doesn't make sense to buying more Ether. It has to be an ecosystem and a thesis, investment thesis, that admits being able to do things beyond the accumulation of Ether that add tremendous value to Ether the asset, to the Ethereum ecosystem, and to your company. And so that means using their Ether to build a lot of extremely high value infrastructure. As we move from being a very centralized global economy to being a more decentralized global economy, many new foundational protocols are being built and will have to be built, and we will be in there in the early stages, supporting them with our Ether liquidity and investing in them and growing them into civilization scale infrastructure.
Okay. Does the OpCo become a good hedge then? Because you have two activities that you're focusing on now, so the OpCo activities becomes a pretty decent hedge then, right? To ETH accumulation.
It does. I think of it more as complementary than a hedge, especially if you are, the underlying treasury strategy is a generally long directional only strategy in the value of Ether. And if you're building, Ethereum companies and Ether denominated revenue companies, I think of it as being complementary and being able to create revenue that attracts a multiple that really helps for your investors, and it becomes a flywheel. So I think of it less of a hedge as more as synergistic and complementary.
So what do you think is needed to keep this flywheel going? I mean, obviously you can keep issuing equity in a rising market, but from your perspective as CEO, as for a long-term vision, what needs to keep the flywheel going?
I'm going to answer it in a funny way. I think the most important thing is investor education. And I know that's not the answer you expected, but for a long time, Bitcoin and Ether traded, big asset, medium asset, and pretty much in lockstep. I know there were periods where it really diverged, but over the past several years, it did diverge. And I think part of that was just when the institutions started coming and buying, they understood the Bitcoin story. Store of value, deflationary, hedge against geopolitical risk. Ethereum was a harder thing to explain, not to convince people, but to explain. And now that they get that it's a store of value, it has been deflationary. In fact, if you look at the last 10 years, Ether has actually done a really good job in performance against Bitcoin. It really has on almost every measure. But I think it starts with not marketing, not snazzy POCs. It starts with education and real world adoption. And before you start getting into any financial engineering, to me, telling that story, meeting with investors, doing real things in the ecosystem around stablecoins and tokenization and DeFi, to me, that's the number one thing. Second is we've been raising capital primarily through equity, initially through a pipe and then mostly through at the market activity when our multiple to NAV has been above 1. I think Ether also is a more volatile asset than Bitcoin, which means there are opportunities for investors who seek a volatility trade to do equity linked type strategies to raise capital from that substrata. But it's a funny answer. I think it has to be through education and adoption before any financial engineering.
Yes, the introduction of Ether DATs is the kind of opportunity that we've been waiting for and expecting for years. It gives us a platform on your podcast, on conferences, other podcasts, on CNBC, on Bloomberg, in our earnings calls to speak to Wall Street. And Wall Street, once it embraces this approach, Main Street will start paying more attention. And so Bitcoin has had a simple value proposition and a simple narrative. And in terms of mind share, it is becoming clear to the world that Ether is the next Bitcoin.
How do you market your business to investors?
Yeah,
You're
that
a
would be
public
my
company.
question. No, go ahead. Yeah.
I think it's a little bit of what we've been talking about: institutional, professionally run, differentiated with our relationship with consensus through a strategic partnership, Joe being our chairman, but more importantly, like a common mission. We are not a hedge fund. We're not a hedge fund vehicle. And that's the first way we try to differentiate ourselves. But more importantly, we tell people about the Ethereum long-term opportunity. And what do I mean by that? If you believe that stablecoins will grow, real-world asset tokenization will explode, DeFi will be embraced by institutions, then you can explain to investors that in a simple asset-based fundamental model, the more activity on Ethereum and the L2s will lead to a higher price of Ether. And if you believe the former, which you're seeing happen with your own eyes, then there's a fundamental way to think that Ether is both undervalued, and we're at this moment where you should be accumulating as much as possible. So we start with a differentiated story of who we are, but we actually start by explaining the long-term thesis, and those two go hand in hand. If you didn't believe the long-term thesis, you wouldn't need a digital asset treasury with Ether as the reserve asset.
Yeah.
Guys, this is fantastic. We're already at 41 minutes. It feels like 5. That's cool. I thought we might move on to because you just brought it up actually, Joseph, to the infrastructure part, the RWA part. Unless Mark, you have anything that's burning in your chest to get at?
I'm not sure if Joseph can chat about this, but I'd love to know about how his infrastructure is set up to deal with yield, how he goes into DeFi, what does he look at, what kind of protocols he's working with. I think it's good for viewers to understand, because it's a traditional way. It allows investors to get into a complex ecosystem via a traditional method. You're not a derivative per se, but you are getting access to DeFi. I would love to know what your infrastructure looks like, what you're doing, what kind of yield you're looking to get out of it, that kind of stuff. If you can talk about it.
I can, but let me set the stage for your viewers. If an investor or an individual or an institution wants to own Ether, historically the way to do it was you'd have some non-custodial account or a custodial account. You would buy spot Ether, figure out how to hold it safely, and then figure out how to stake it to get yield, either through native staking, through your custodian, or through DeFi. Then about a year ago, the ETFs came out, and it was a different wrapper for institutions who didn't know how to do what I just described. They would essentially have a wrapper called an exchange traded product that they were very familiar with, and they got the ETH capital appreciation. They just didn't get the staking, because in the US, the SEC hasn't yet approved staking. And when the SEC does, which I think will be soon, you have an issue of daily liquidity, meaning those ETPs have to be able to satisfy daily redemptions. And when you stake ETH, you're in some staking and unstaking queue, which, Joe, correct me if I'm wrong, used to be measured in days, now is measured in weeks. So you're likely not going to be able to stake even 50% of your ETH if you're a responsible fiduciary. So you're right, owning an ETH DAT gives you a way to own the ETH capital appreciation without a asset manager fee, and with an ability to stake 100% of the assets to earn yield, 100%. And that's what we've been running at. Nearly 100% of our assets are staked. To date, we've been walking before running. We're a young company. We needed to make sure we can do this responsibly. But today, it's the majority is native staking through delegation through our 2 custodians. We also own a position in a liquid staking token. And we're at the point right now, in fact, this week, where we are going to be spending time thinking of this as a portfolio of staking, a portfolio of yield. And no different than your own portfolios, you need to have a strategic way of thinking about it, risk to reward, and you need to figure out how to allocate against different opportunities. And that's what I think the next step is, to think of it as an efficient frontier of risk and reward, and then go out into the ecosystem with those large stacks of ETH to put it in the right places and make sure that we're being rewarded, including by bootstrapping different protocols and being, I would say, kingmakers, moving assets to the most responsible protocols. And I think that's really, really important. So again, think of it as, first, you need to have exposure. Second, you need to stake. and we're going to do it in a really, really smart way. And Joe and Consensus and the team give us access to the greatest minds and opportunities. The final thing I'll say is Consensus has launched a layer 2 called Linea, or in Europe, I think they might call it Linea.
They might.
And it is a fully aligned layer 2 to Ethereum layer 1 mainnet. And you'll start seeing some announcements coming about SharpLink collaboration with Linea, which I think will be really, really positive for our investors in that community. Joe, that was a long answer to a short question.
Yeah. So SharpLink will prudently be transparent about the techniques that it's using. So at the right times, we'll share when things get operational.
Okay, but I'm assuming it's on your roadmap because there's a carry here. You can make money
A
as a
lot
productive asset.
is on the roadmap. Absolutely.
I can imagine. Okay, cool. Sorry, Tom. I was just I had to ask.
No, you had that look.
Oftentimes.
Joe, I'd like to change the subject just a little bit here. You've spoken quite eloquently on the show already about Ether's superpowers as money. Ethereum is also an infrastructure. And these days, everyone's talking about tokenization. We're talking a lot about real world assets. And I'd like to get into a little bit into that and ask you just straight up, what makes Ethereum the best infrastructure for tokenization?
So it's decentralized, credibly neutral. It is an infrastructure that no minority set of actors can improperly manipulate. It is the first implementation of rigorous trustware on the planet, and it's the best. But if you want to talk about real world assets in a more TradFi meets DeFi context, Joseph has a fair amount of experience with that.
Yeah, I just think it's really interesting for those of your viewers who come from traditional side of investment management or finance. It's super clear that the current system is heavily frictioned. You have these intermediaries who play roles to try to move money, to move securities, to help in that exchange of value, but everything is delayed. Some assets settle T+1. If you look at loans, they settle T+20. And you see people holding money over nights and weekends, collecting rents. And what that does is creates massive risks and friction in the ecosystem. You don't know if your counterparty will be there tomorrow to settle. You have to put up collateral and overnight financing often if you don't want to pre-fund a transaction. So the beauty of tokenization is, as Joe said, neutrality and trust, but I would also say instant settlement, atomic settlement, settling in seconds, even if it's minutes. Think of the risk and capital you take out of this inefficient traditional financial ecosystem if you can transact with somebody and it settles instantly. It can settle across borders. It is composable. What do I mean by that? Instead of today, which is 99.9% of transactions are fiat for stock, fiat for bond, fiat for funds, why can't you own the S&P 500 and lend it in a tokenized form? Why can't you exchange the S&P 500 for the NASDAQ triple Q fund? When you have on-chain transactions where you have complete composability and real-time pricing of transactions that can settle instantly, the velocity of movement of money and transactions is going to increase, and that will actually help the pace of our economy, and it'll take out massive risk. So it's the neutrality, it's the trustware, but it's also the instant settlement across geographies, the composability and programmability through smart contracts. It is by any measure better than our current system. And I think institutions went from knowing that but fearing the regulatory to knowing that and being comfortable regulatorily.
Yeah, the efficiency and velocity of our financial infrastructure is going to improve by orders of magnitude. So whether it's banking systems, brokerage systems, securities, commodities, etc. There is so much computer and human and regulatory infrastructure, and not to mention the lawyers. The lawyers going to run the world, and in the near future, we're going to need lawyers to help us make sure that the smart contracts are written appropriately, pay attention to the laws, but we're going to be able to build regulation into the smart contract infrastructure. We're going to be able to run everything automatically, clearing and settling in the instant of the transaction. No reconciliations necessary in a single global ledger. And the velocity of value creation events, the duration between value creation events is going to shrink dramatically, compounding that value creation much more dramatically.
Can I add one thing which is going to sound cliche or futuristic at the same time, but I don't care. Finance, as much as any other industry, is starting to try to adopt agentic workflows, so using AI agents. And they're doing it because there is massive cost pressure, there's labor pressure, and they realize that many of the workflows can be handled through trusted or trustless agents.
Mm-hmm.
I think Ethereum is going to be the place where a lot of that activity is going to happen, not just in finance, but in non-financial workflows. I would encourage readers who are really geeky to read the proposed Ethereum ERC 8004. This idea that Ethereum will have on-chain agent-to-agent protocol transactions where you can rely on identity and reputation and the validation, and you don't need to write this off-chain logic of what an AI agent can do. It'll understand boundaries. And I think not years from now, but much sooner, you'll start seeing each of us have AI twins or AI wallet twins who will understand your preferences and be able to execute on them in your portfolio or in predictive markets or in how you govern parts of your lives. And I know adding AI to the conversation, again, is often cliche. This is going to have a massive impact, not just on the use of Ethereum in financial services, but in your day-to-day lives.
Yeah.
And I think it's going to be underestimated. And I think people believe it's years away, and I think it's months away.
Yeah, and the AI agentic economy is being built out really heavily on Ethereum, so that that registry of agentic services is an Ethereum native construct.
Cool.
Amazing. Love that. If we can go back to the RWA side of things, if you don't mind. Look, I think Joseph, you mentioned it very eloquently. So we're moving up the risk curve, right? We had tokenized cash. Now we're doing tokenized government bonds. We get yield. We're doing tokenized public equity. And we're doing private credit. I think we'll go into private equity. I think that's kind of where we should be going to. I think public equities on chain is just a way for crypto natives to borrow against a lower vol asset than they currently borrow against, say, ETH or BTC. I think that's going to be hugely beneficial for the ecosystem. But when it comes to RWAs, as it stands, there's no such thing as native issuance on chain, right? So I think we'll get there. We're not there yet. Part of, just a little Gen2 plug here is that what we're doing is we're building the financial engineering layer before tokenization happens, because you need the structured issuance in the SPVs, in the off-balance sheet structures before you can even do RWAs on chain. Now, things are happening in the Middle East, things are happening in Switzerland and elsewhere where we can see slowly regulation changing, but I'd love to get your view on some of this stuff. Is that how many years away do you think we are from doing native issuance on chain, where we abstract a lot of the complexities behind the financial engineering side?
I think the core infrastructure for tokenization started getting built in like 2016, 2017.
Right.
I feel like 2017, I remember being at conferences in 17 and 18, and it was the promise that was the year of tokenization. And it turned out it wasn't.
No.
It wasn't, right? Like you could just see by the assets secured that it was too soon. And part of that was, to your point, the infrastructure being there, having qualified custodians, having digital transfer agents, having clear regulation. I think that's all very important, but I think there's something that the industry is missing, which is all the promises we talked about. Why tokenization, neutrality, trust, instant settlement, this idea of composability and programmability are all amazing. But if you don't have liquidity, then what is the point? So I think what we're starting to see, ironically, is that the infrastructure is now maturing. There are many players who are entering this field who are trusted and have good engineering capabilities and protocols. I think we need to start seeing the liquidity. And one of the reasons why, I was so proud of the final work we did at BlackRock before I retired was this idea of tokenizing a fund that actually gave utility and was liquid. So at BlackRock, we tokenized a short-term treasury fund called BIDL. And it wasn't to do a press release. It wasn't because we were doing a POC. You were actually living fully 24/7 natively on chain on Ethereum. And you could provide yield to people who wanted to sit in your token and in an instant move them back to a stablecoin when they needed to interact on chain. But what I just mentioned is liquidity, the idea that you can have a stable value security token interchangeable in an instant with a stablecoin. That is what's necessary. And we're going to go up the risk curve. But as we do, we need to make sure that we're not just tokenizing things, but there are venues that provide liquidity for that private equity fund, for the private credit. It's really, really interesting to tokenize, but only useful if you can actually trade with others in an efficient manner. So I would just say the promises are there, the infrastructure is there. We need to bootstrap that liquidity.
Yeah, sorry, go on, Joe.
I think things are going to move faster than you were suggesting. If you look at equities on public American markets, in projects like Superstate tokenize equity natively, and they have their own transfer agent approach where they're working with a traditional transfer agent, and they can move from the traditional form of equity at the DTCC to a tokenized form. You can go back and forth. And the NASDAQ is working with the SEC to tokenize all the equities. Project Crypto, Paul Atkins and Hester Peirce are driving that from the SEC's perspective. So there's a real drive in the United States to make this happen as quickly as possible.
Cool.
Well, guys, this has really been fantastic. We're almost at an hour, and I think our time is coming up. Unless there's anything we've missed from the Joe and Joseph side.
Pretty thorough.
Yeah, pretty thorough. It was great. Well, then, in that case, gentlemen, thank you very, very much for coming. It's been a fantastic conversation, and we both very much appreciate your time and your insights.
Thanks, guys. Great seeing you, Tom.
Thanks for having us.
Great seeing you as well.
This is the Assetizer Podcast.